In the entire public stock market, there are very few companies as unique or, frankly, as powerful as TransDigm Group. Whether you're a seasoned investor or you just love fascinating business models, this is one company you absolutely need to understand. And this right here, this isn't some fluffy marketing slogan. This is TransDigm's official stated goal. And that single sentence is the key to, well, everything. It drives their entire strategy, their culture, and it explains both the incredible returns and the pretty significant risks we're about to get into. So, what do they actually do? Well, to put it simply, if you've ever been on a plane, you have relied on a TransDigm part. They make these super critical, highly engineered components that are just essential for flight. And the crucial part? For a huge number of these parts, they are literally the only company in the world that makes them. All right, so here's our game plan for breaking this all down. First, we're going to look at their public PE firm model. Then we'll dive into the unbreakable profit engine. That's the big bull case. After that, we'll tackle the bear case with a mountain of debt. Then we'll ask why the stock demands the price of perfection. And finally, we'll wrap it all up with the investor's dilemma. Okay, so let's jump right into the core of their strategy. See, TransDigm doesn't really operate like a normal manufacturing company. Its entire playbook, the whole thing, is lifted straight from the world of private equity. Their growth model is this incredibly powerful, self-reinforcing cycle they call the flywheel. Here's how it works. They take all the cash from their existing high-margin parts. They use that cash to go get a bunch of debt to buy other component makers. Then they apply their aggressive playbook to jack up the margins of the company they just bought, which generates even more cash for the next deal. It's just a brilliant machine designed to compound value over and over again. So what is it that makes that flywheel spin so incredibly fast and so profitably? To really get the bull case for TransDigm, you have to understand the source of what we're calling its unbreakable profit engine. Now, if you look at where their sales come from, at first glance, it looks pretty balanced, right? About 40% comes from defense, another 31% is from selling replacement parts to airlines for planes already in the sky. That's what we call the aftermarket. And the last 27% is from parts for brand new planes, the original equipment or ODM market. But that revenue mix is actually kind of deceiving, because while defense is the biggest slice of the sales pie, that commercial aftermarket business is by far the company's real profit engine. The margins on those replacement parts are just astronomically higher, and it provides this incredibly steady, recurring stream of pure cash. So how on earth do they protect those incredible margins? Well, this is where it gets interesting. They have one of the widest economic moats you will find anywhere. First, something like 90% of their sales come from parts where they own the intellectual property. Second, once a part is designed into an airplane, it's basically locked in for that plane's entire 25 or 30-year life. Switching is nearly impossible. And third, you've got the FAA and other global regulators creating these massive, expensive barriers for any potential competitor. That combination gives them just unbelievable pricing power. And to really put this into perspective, let's just compare them to their closest competitor, a company called HEICO. HEICO's whole model is to reverse engineer parts and then sell FAA-approved generic versions. But TransDigm's strategy is totally different. They buy the original company that designed and certified the part in the first place. By owning that original IP, their competitive moat is just that much stronger. Okay, but there's always a but, right? That amazing acquisition flywheel we talked about is fueled by debt. A lot of debt. And this is the absolute core of the bear case. The biggest risks are tied to the exact same strategy that makes the company so darn successful. And the numbers, they're just staggering. As of late 2024, the company was carrying roughly $24 billion in total debt. This leverage is the engine of their growth for sure, but it is also, without a doubt, their single biggest vulnerability. So this mountain of debt creates a bunch of risks you really have to think about. First, all that leverage makes them really vulnerable to economic downturns or big changes in interest rates. Their fate is also tied to the very cyclical airline industry. And you better believe that amazing pricing power has attracted some regulatory heat. A past Department of Defense audit actually called out their excess profits. And finally, the whole model hinges on them perfectly executing acquisitions, not overpaying, and not messing up the integration. That's a lot to get right every time. And that brings us to the stock's valuation. TransDigm always trades at this huge premium compared to its peers. So the big question for any investor is the market correctly pricing in all those unique strengths we talked about, or is it kind of overlooking these really significant weaknesses? And here is exactly why that premium exists. I mean, just look at this. TransDigm's profitability is in a completely different league. Its EBITDA margin, which is a key way to measure cash flow, is over 50%. For comparison, its peers are lucky if they can hit 15%. This isn't just a small difference, it is structurally on another planet. And you can see that massive profitability gap translate directly into its valuation. TransDigm commands these premium multiples like EV to EBITDA or price to earnings that are way higher than what you see for huge respected players like RTX and Lockheed Martin. The market is simply willing to pay up big time for that superior margin profile. So let's just boil it down. The market justifies this premium price for four main reasons. One, the profitability is just unmatched. Two, you have that high-quality recurring revenue from the aftermarket. Three, they have a decades-long track record of creating value with this model. And four, that economic moat we discussed is incredibly wide and durable, which protects all those future cash flows. And this all brings us to the final and most critical question for any potential investor. It's a classic dilemma, right? How do you weigh a company of such exceptional quality against the exceptional risk that it carries? Because on one hand, you've got the bull case. You're buying into a superior, heavily protected business with a proven machine for creating wealth. But on the other hand, you've got the bear case. It's an incredibly leveraged company that depends on a healthy airline industry and just flawless execution. The tricky part is both of those statements are 100% true. And that, right there, is the investor's dilemma. So I'll leave you with one final critical question. The law of large numbers is undefeated. As TransDigm gets bigger and bigger, it gets much harder to find acquisitions that are actually large enough to move the needle. Can the acquisition engine that built this massive empire continue to fuel its future? Well, that's the billion-dollar question.